Welcome everyone to an episode of Mere Finance. We couldn't miss the opportunity to talk about this big event of banks collapsing. And although every media pundit and every so-called expert out there is calling for like this as the credit event, we are not convinced that this is the credit event. We are going to see a big credit event coming up, and it's going to bring the markets down probably next week. So mark my words first here. You saw it here. This is our prediction. And because we develop our predictions based on conditions, and conditions dictate probabilities. So we all know, Silicon Valley, customers' total deposits went up, and terrible mismanagement in asset to liability caused a big influx of money, a bank run, because as what they did is what textbook Keynesian economics is. You get the money from customers and you invest them in relatively safe assets such as US Treasuries and agency MBS securities. But when you have yields at so low, like the 10-year at 1.8, and your weighted average yield for mortgage-backed securities are like 2.6%, you're following what you're supposed to do, invest in safe assets. But as the markets and the Fed raise rates, well, you cannot pay your customers the money they deserve, right, in interest, but you're also getting way less yield in your investment, so you end up having losses. But I don't think it's the bank itself's fault. It's also the Fed Reserve following a big high and having absolutely no control of inflation, but also 10 years of very loose monetary policy. So a credit event is brewing. And why do we think it's brewing? Well, you think, for example, in December, we had the fifth worst December for the markets in history. And we could definitely see that coming because of the different sectors. So let's start with lumber. Lumber versus gold. Lumber is an important indicator because it shows economic growth, labor, and housing. And housing is a key indicator of the whole market. You can see how in November, you start seeing a small decrease in relative decrease of lumber against gold, which gold is considered as safer asset. And you can see how in December, the market then crashed. So you can see the indicators showing clearly in November how lumber starts going down. Let's see. Another sector that is important to analyze, which is utilities. Same. See how utilities relative to the market starts going down in October because we had a great October time. It went up, the market went up 17%. But then you can see how in November, slowly starts to going up. Even before December, slowly goes up. Then in December, we crash. And then look at what we see lately in March. Utilities also going up relative to the market. Consumer staples, the same textbook example. When it crashed in December, the market, look at how in November relatively starts weakening, and then in December, when the market is crashing, it got relative strength. Again, as the market's crashing, we can see consumer staples slowly creeping up. So something is brewing. Let's see also small caps. Small caps are a great indicator of domestic output because most companies in the overall market have a lot of operations worldwide. So the Russell 2000 is a great example of how the US economy isolated is working. And you can see how in March it's totally weak in comparison to the overall market. And this is a huge indicator that the whole market might have a meltdown. You can see clearly also in December how the relative strength is just violently going downwards. And even though we've seen a lot of quantitative easing in the last 10 years, emerging markets did poorly because the US dollar and the low rates in the US made the US markets a very attractive place to be. But now that inflation is out of control in the US, because the Fed lost grip of it, it's going to cause a big credit event by raising rates so fast. Because they raise rates so fast, it's just a policy of not having inflation way before the time came in control. So emerging markets are going to start doing better in this new regime. You can see the strength in November, how it went down, but as the markets start crashing in the US, emerging markets also went up. And we're going to see. Now, emerging markets here in March are slowly weakening, but we'll see how next week it will start picking up again relative to the market. And despite all this systematic risk from Signature Bank and Silicon Valley, the VIX is not even touching 30, it's at 26, which means the market still doesn't think it's a huge systematic risk. Remember, volatility produces risk off because people don't want to deal with that. Investors don't want to deal with that, so they go into safe assets such as treasuries or high investment grade bonds. So in this case, as volatility is still not there where we want to be high enough, there is no risk off yet. So what happened this week is not really risk off. It's just a little volatility, but the real risk off we will see is when it comes probably next week when we have the credit event. And also, you can see here in December how treasuries usually do amazingly well when the market goes down, except for, of course, 2022, where both were really correlated. But you can see how the S&P crashes, the green graph, the green bar, while the long duration treasuries just goes up. So we'll see. TLTs having a great yields are going down, but the price of bonds are going up because slowly there's a fly into safe assets. So these are our words. Credit event is brewing. It's not this one. Something is going to break. Next week, we will see market turmoil. So thank you for watching. Let us know what you think, and don't forget to subscribe. Thank you.